Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a look at a recent development that at one level has been discussed and debated at length, the RBI's latest bi-monthly monetary policy statement. But rather than looking at the policy per se, we're going to take a look at it in the larger context of economic growth. What is really holding back private investment? Is there a way out of the apparent morass in which we find ourselves? Does the solution lie in the realm of monetary policy, fiscal policy, a combination of both, or does it call for more direct government intervention? And joining me in the discussion are three eminent economists representing the best of monetary and fiscal economics in the country. I have with me Dr. Rangarajan, former Governor, Reserve Bank of India, Chairman of the PM's Economic Advisory Council to the former PM Dr. Manmohan Singh, Dr. Govinda Rao, former Director NIPFP, the Delhi-based fiscal think tank, and also a member of the 14th Finance Commission, and Ashok Lahiri, also a former director of the NIPFP, former chief economic advisor, former executive director to the ADB, and presently chairman Bandhan Bank Limited. Welcome to the show, all three of you, Dr. Rangarajan, Govinda and Ashok. Yeah. Let me start with you, Dr. Rangarajan, since the immediate peg really is the RBI's latest monetary policy statement. Has monetary policy reached the limits of what it can do to revive growth? Not only in India, but in the world at large, there is a sense that the power of central banks is waning. Consider how the huge increase in liquidity that we saw post the global financial crisis, the quantitative easing is a euphemism for what we in India would have called deficit financing, has not really moved the needle on inflation. So let me ask you to answer this question in two parts, one with respect to India and two at the global level. Dr. Rangarajan?
Well, the policy statement issued a few days ago is along expected lines given the current situation relating to inflation. Perhaps this is the right decision to take. But the more important question is that at this particular point, it is only a signal from the central bank. Whether the banks will act according to the signal, that depends upon a number of other factors. And therefore, there is the immediate question in relation to the banks in India, and then there is a larger question which you raised about what is the role of monetary policy in the conditions that prevail in India and elsewhere in the world. As far as India is concerned, I do believe that the problems faced by the banks are far wider than what the pure monetary policy can direct at, because the signal may be taken up, but action may not follow because of the difficult situation in which the banks are placed. Therefore, unless some action is taken or banks themselves take the necessary action to correct that situation, perhaps the signal sent out from the Reserve Bank may remain only as a signal, and perhaps action on the part of the banks may be delayed. In general, you raised the question about the extent to which monetary policy can influence the situation. There is an old saying in monetary policy, in the literature on monetary policy, that the monetary system has efficient brakes, but the accelerator is uncertain. It is always possible for monetary policy to bring about a brake when things were overheated. But when you want to stimulate an economy, I think the monetary policy's role is somewhat limited. It can only act as a facilitator in some ways. The interest rate can be brought down.
Govinda, Dr. Rangarajan put it very well, saying that monetary policy cannot accelerate, it can only brake. But would you agree with that assessment? And I know you are a fiscal economist essentially, and so it must be good in one sense to see monetary policy becoming less relevant vis-a-vis fiscal policy, which as a government's domain must frankly to my mind be always superior to the domain of a technical body like the central bank. But even so, would you agree that monetary policy cannot do much for the Indian economy at this particular juncture? Govind?
Well, after what Dr. Rangarajan said, I don't think it is possible to improve upon whatever he has said. You know, the fact of the matter is that there has been so much of pressure on the Reserve Bank itself, saying that, look, I mean, growth is decelerating, There is tremendous amount of liquidity in the system. The inflation rate is low, so there has to be reduction in the interest rates, etc., etc. Well, I mean, it has given the signal in terms of reducing the interest rate by, the repo rate by 25 basis points. But the basic problem, as Professor Rangarajan said, lies in, the sentiments. Now, first of all, banks are not willing to lend even at low rate of interest because there is a huge number of problems they are faced with. The non-performing assets, and and then of course the regulatory issues, the whole lot of things that they are faced with. The industry is not willing to borrow because they themselves have a huge balance sheet crisis, and in this particular situation, what Lord Keynes said, the marginal efficiency of capital is, it's much below the rate of interest. How much rate of interest can you reduce?
Ashok, if all that monetary policy can do is give signals, and signals that nobody heeds, then is there any point really in pursuing monetary policy at all? Has it come to the end of its limit? Ashok?
I think Mythili, Dr. Rangarajan and Govind have summed it up well. I'll just say that let's take the MPC's latest decision of reducing the repo rate by 25 basis points. I think it's a welcome decision because inflation rate has come down. At least it appears to have come down, and the signaling had to be done that in line with the declining inflation, we are reducing it by 25 basis points. But let's come back to the question, what can it achieve? First, the question is, are the banks short of liquidity? I saw a number like $60 billion of excess liquidity with banks. So if the RBI comes and says we will lend at an even cheaper rate than what we used to, is that going to solve the problem? The answer perhaps is no. Because if you look at SLR, if you look at cash and balances with the RBI, they are all over their statutory limits. So the question is, why is there excess liquidity? I think the problem is on the demand side, and the demand side problem is related to the twin balance sheets problems.
Dr. Rangarajan, whatever the reason for the RBI's problems and the fact that the RBI has a very difficult job, the fact is that if monetary policy can't do much at this juncture, should we turn to fiscal policy? Because after all, economic growth can only be driven by two levers, monetary policy or fiscal policy. So it's always a question of which one will be more beneficial to us in a scenario where growth has not picked up really. And even when growth has picked up, investment has not picked up. So what do we do to get investment to move up again? Dr. Rangarajan?
Well, the monetary policy has to do what it can do. We recognize the limitations, but certainly some signals are needed given the current situation relating to the inflation trends. The decision to lower the policy rate is appropriate, but I think there is also a problem with transmission of the signal. I think we need to look at it a little more carefully because all central banks make forecasts of inflation, and the RBI also does. Perhaps what we have seen in recent times is the RBI has overestimated the inflation or the coming inflation. If perhaps a few months ago, if this was a situation that would prevail with respect to inflation was recognized, perhaps they would have lowered the rate even earlier. So there are problems. I think I'm not blaming RBI, but the forecasting inflation is a very hazardous problem, and problems exist in relation to all the models that are being used.
So should we try the fiscal route?
No, I'm saying that whatever monetary policy can do in terms of signal or in terms of doing whatever is necessary for transmission must be done. But then we need to reactivate, as you say, other instruments. Ultimately, even fiscal policy has its own limits. Fiscal policy cannot really go beyond a particular point because there is a limit on the extent of deficit financing or the extent of fiscal deficit that you can run also. Therefore, the way in which it will have to be done is we create a situation in which the increased public or capital expenditures have a way of stimulating private investment. Until private investment picks up in a big way, the economy is not really going to go in a very fast way. Therefore, we do recognize the role of fiscal policy, but we also recognize the limits as far as the fiscal policy is concerned in terms of the fiscal deficit it can really tolerate. Therefore, the public capital expenditures must be in a way that it stimulates the private investment. Therefore, you really need to look at what else can be done apart from fiscal policy in order to stimulate private investment.
So if monetary policy has its limits and so does fiscal policy, what do we do? But after a break, when we'll come back to you, we'll ask Govind and Ashok because they are the fiscal economists on our panel. Welcome back. You're watching Macros with Mythili and we're discussing the latest monetary policy statement of the Reserve Bank of India and what can it do to stimulate growth? What is the way out? Govinda, before the break, Dr. Rangaraj was talking about the limits to both fiscal as well as monetary policy. But the fact is that if private investment is not picking up, there is no alternative but for public investment, that is fiscal deficit, to increase, step into the breach as it were. What is the sanctity of 3%? Isn't the quality of the deficit more important than the quantity? Govind?
Let me first say that I think, as always, Dr. Rangarajan made very pertinent point. The Reserve Bank does have a problem, particularly in having, in fact, the forecasting of inflation at this particular juncture. The entire disturbance caused by demonetization and the liquidity that came to the system, as the Reserve Bank rightly put, in the statement they said, there are transitory factors, there are structural factors. And these transitory factors have really overshadowed the structural factors in dealing with, in the inflation forecast in particular. And one doesn't really know what would be if you take out the transitory factors, what would be the impact, what would be the inflationary impact. And that makes the Reserve Bank's task that much more difficult, number one. Number two, as far as the fiscal policy is concerned, it is, we have continued to squander the opportunity, as Reserve Bank again put it. The things like loan waiver and, pay commission recommendation and things like that takes away even a little space that you have for public investment. If you go on increasing, this type of transfer payments and then public consumption, obviously the public investment takes a hit. As far as the 3% the target is concerned, see, these targets are fixed based on household sector financial savings. When the household sector financial savings, at this particular moment, even after the review committee of NK came up, they have, after all the talk that they had about reviewing the fiscal deficit target, they also come down to the same sort of a view, saying that over a period of time you have to reduce it to 2.5%. Now the question, when the things are good, you don't reduce the fiscal deficit. When the things are bad, you don't really calibrate a counter-cyclical fiscal policy, because your fiscal policy as of now is managed on the basis of day-to-day things and then ad hoc decisions. This is not the way we can go do that. But at this particular moment, public, obviously there is a limit of, for public investment to take the lead in reviving the economy. To the extent that it can, they have tried to do it. They have tried to front load the public investment and all that. But the main critical issue is, how do we really revive the private investment in the economy? Because you can't, continue to say that I will have a high growth, with only the private consumption taking place and then some government expenditure contributing it. If that is the reason why it becomes extremely imperative for us to deal with the whole issue of twin balance sheet crisis, get the policies in a proper space, and proceed on that account, because exports are not picking up again because of the global situation, and resolution of the twin balance sheet crisis is critical. Having said that, I also would like to say that, look, I mean, you have a situation where the banks are getting short-term funds. And for private investment lending, you need long-term funds. There is a mismatch. You don't have corporate bonds market developed. There are a whole lot of policy issues that we need to really put in place to develop the corporate bond market, to revive the savings. In fact, Dr. Rangarajan has recently written an article in Economic and Political Weekly about the whole issue of revival of savings and things like that. So you do need to have a package of measures to do that. Ease infrastructure bottlenecks, as Ashok mentioned. There are a variety of things that we need to do, and just saying that the monetary policy and fiscal policy is not going to help us.
Govind, I entirely agree with you, and I'm sure Ashok and Dr. Rangarajan also agree with you. But the point is that yes, we have these problems. But today, what can we do? Ashok, you've seen it all as the head of the relatively independent fiscal think tank. You've been an insider to the workings of the government as a chief economic advisor, and you also have a cross-country perspective. So what would you say, given the problems that we have today in getting private investment to kind of increase, can fiscal easing be an answer, however temporarily, provided it is of the right quality? Ashok.
Mythili, that's a tough question, but first let me start with the inflation forecasting. I think, on a slightly discordant note, it's a bit premature to declare that RBI may have been wrong in its inflation forecast. The inflation forecast for RBI was on half-yearly basis, and I'm not absolutely certain that the half-yearly inflation will be well below what they forecast, just because in a month or two inflation has been less than 2%. But let me come back to your question. Now look at China. China had an infrastructure boom without any explicit or overt fiscal deficit problem. Now most of the time what we say is that if private investment in infrastructure has to be incentivized, we need to crowd them in with public investment. But mind you, there are many ways of doing it. One is the government putting money on the table. And when you are putting money on the table, you have to ensure that that money is well spent. If the pipe is leaking, then you have to make sure that you are not pumping too much through it and it's all leaking out. I think the Indian economy was on steroid. After the global financial crisis, we avoided it by pumping up fiscal policy. But now, as with human beings, when you are on steroid, there are side effects. We are seeing the side effects now. But mind you, the underlying seems to be quite strong. Look at the stock market valuation. I just don't understand the stock market valuation. The BSE Sensex over 30,000, 31,000, the NSE over 10,000. The markets seem to be betting on India. Now, how do we get it all together? I think, given the state right now of fiscal policy and monetary policy, we must find clever ways of declogging private investment, better regulatory regime. For example, roads that are being built. Land acquisition is still a problem. Land acquisition is taking years to, even metro projects are getting stuck. Second, about toll collection. We are getting all sorts of problems in toll collection. A contract is a contract. We must have a better contract enforcement system. And if everyone is betting on the Indian economy, I think much of this investment boom can be brought about by improving the ease of doing business. This is not to deny that the government doesn't have to get its act together. And when you say quality of fiscal deficit, the quality of fiscal deficit is a very dangerous term, because no government anywhere in the world will ever admit that the quality of its fiscal deficit is bad. Everyone says they are doing the right thing. So I wouldn't go too much for quality of fiscal deficit, but keeping the fiscal deficit constant, there must be ways of shifting expenditure from what removes poverty here and now, or at least claims to remove poverty here and now, to what actually removes poverty on a sustained basis. I think that is what we must look for. So what I am saying is, we must focus on structural reforms.
Absolutely. And in fact, Ashok, that brings me to my last question of this discussion, because we've really run out of time. But Dr. Rangarajan, very quickly, there are basically only two ways you can increase growth in the country, either by increasing investment or by increasing the iCore, that is the incremental capital output ratio, which is a measure of how productive we are and how efficiently we're using capital. Since it seems so difficult to increase investment, can we possibly try and improve the iCore to make capital work more efficiently? Very quickly, I would like your response to that.
Well, the iCore can be brought down in a number of ways. For example, one of the things that can be done is really to see whether the stalled projects can be really speeded up, and whether action can be taken in order to do it. Because the iCore can go up just because of the delay in the completion of projects, because of the lack of coordinated investment and so on. Therefore, one quick way of doing it will be to see what is happening to the stalled projects and clear them. And so as you complete them quicker, you can get greater output, and therefore that is one way of doing it. And I believe they have been looking at it. One doesn't know yet whether there has been very substantial reduction in the number of stalled projects, even though some stalled projects might have become unviable because of various other conditions.
Govind, would you like to add to that very quickly? How do we improve the efficiency of capital?
I think the focus on stalled projects is the way forward. That's one. But then, you know, as Ashok mentioned, you still have the problems with you know, land acquisition and you know, sort of various other policy. You know, we need to have a cohesive policy environment in place. But if you really, I mean, you know, sort of bring in greater technology and things like that, and we also should see whether, you know, what happens to employment. I mean, that's another issue, because you see, iCore can be brought down by improving, you know, sort of getting better technology. I mean, these are things which cannot be done in the short term. I mean, they cannot be done in the long term. But the better thing for the government would be to save money on many of the, you know, bad public enterprises, get rid of things like Air India, use that money, you know, sort of, you know, so instead of using money, you know, budgetary resources for them, use that money for investment, improve the infrastructure. Improvement in infrastructure will improve the iCore, and that is the way forward.
Ashok, your closing thoughts?
Mythili, I am with blinkers. I believe infrastructure is the issue. We need roads where we don't take 6 hours or 8 hours to travel 200 kilometers. We need ports where an exporter can load his products and send abroad quickly. We need electricity that does not fail. We need water supply that doesn't give you dysentery, and you need 24-hour water supply. You need sewerage. You need planned cities. In urbanization, if you look at urbanization, the rate of growth of urbanization has slowed down beyond 81. We have unplanned cities. Go to any city and the traffic is just a killer. Go to China and look at their cities. In cities without any people, they have 6-lane roads. I am continuing to dream about an India which will have infrastructure which will be almost as good as that of China.
Well, yes, certainly the problem is far more complex, and there are no simple solutions or answers to what is holding growth and investment back. But hopefully, as with all complex issues, we are slowly getting there. In a democracy, speed is bound to be slower than in a country like China. Thank you so much, Dr. Rangarajan, Govinda and Ashok. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now. In the meanwhile, if there's any other issue you'd like to see discussed in this program, do write in to us at the mail ID you see at the bottom of your screen.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.